We are covering these 7 top stocks with big percentage gains today. While watching bullish price actions, let us inform you our review on ALBT. Avalon GloboCare Corporation is making moves in the precision diagnostics space, and investors are keeping an eye on how these developments could shake up the stock. The company has a solid footing in lab services, specializing in genetic-driven testing, toxicology, and wellness diagnostics. But what's really interesting right now is how Avalon is expanding its proprietary testing portfolio and pushing into the commercialization of its Keto Air breathalyzer system, a potential game-changer in metabolic and respiratory health monitoring. On the business side, Avalon has been working to strengthen its lab services MSO segment, which is key for revenue growth. The company's focus on genetic-based diagnostics and expanding test offerings aligns well with a rising demand for personalized healthcare and precision medicine. If Avalon can scale its proprietary testing efficiently and gain traction in the market, it could provide a nice boost to its financials and investor confidence. At the same time, there's always the question of execution. Commercializing new medical tech, especially something like the Keto Air breathalyzer, takes time, regulatory approvals, and market adoption. If Avalon can navigate these hurdles and secure partnerships or distribution deals, that could be a catalyst for the stock. On the flip side, delays or struggles with scaling could keep the stock range-bound. For investors, the big question is whether Avalon can turn its innovative pipeline into consistent revenue streams. It's a stock to watch, especially as it moves further into proprietary testing and looks to carve out a niche in diagnostics and metabolic monitoring. Our review on ADTX. Aditxt Incorporated has been making serious moves in the biotech space, and investors just sent the stock flying nearly 100% in a single session. That's not something you see every day. The reason? A major funding push and progress on its pending acquisition of Avalon Therapeutics. If you're watching the biotech sector, this is one to keep on your radar because what happens next could be a game changer. Let's break it down. Aditxt subsidiary Aterian and its acquisition target Avalon just submitted applications for up to $117.5 million in federal funding. That's a massive potential cash injection aimed at supporting the development of infectious disease treatments, including antifungal therapies and broad-spectrum antivirals. If even a fraction of that funding gets approved, it could fuel early-stage clinical trials and push key drug candidates forward, which is exactly what investors want to see from a biotech company in growth mode. And this isn't Avalon's first rodeo when it comes to securing government support. The company has already pulled in $33.2 million in prior funding for its ATI 1701 biodefense vaccine, a project that's backed by a partnership with the U.S. Air Force Academy. That kind of government relationship is significant. It not only adds credibility, but could also open the door for additional funding down the line. Now, on top of the funding news, there's also the Aditxt acquisition, which is inching closer to the finish line. The deal has a March 31st deadline, and if it goes through, Aditxt will get access to Avalon's pipeline and its government-backed projects. That could be a major strategic win, positioning Aditxt as a key player in infectious disease treatments, an area that's still in high demand post-pandemic. Of course, there's still risks. Government funding isn't guaranteed, and if those applications don't get approved, it could put a damper on the momentum. Also, biotech acquisitions can be tricky. Sometimes they take longer than expected, and sometimes they don't deliver the expected value. But right now, the market is clearly betting on the upside. For investors, Aditxt is shaping up to be a classic high-risk, high-reward biotech play. If the funding comes through and the acquisition closes smoothly, this stock could have more room to run. But if things stall or the deal doesn't go as planned, we could see some volatility ahead. Either way, this is one to watch closely as we head toward that March 31st deadline. Our review on AGH. Aureus Greenway Holdings Inc. is quietly making a name for itself in the golf and hospitality space, operating two sprawling public golf country clubs in Florida. With 289 acres of prime recreational property, these clubs offer more than just golf. They're full-service destinations with food, drinks, retail, and membership perks. And while golf might not always be in the headlines like tech or biotech, it's a steady business with strong customer loyalty, making Aureus an interesting stock to watch. Now, here's where things get interesting for investors. The company has been working to expand its revenue streams, leveraging not just the greens, but also its pro shops, food and beverage services, and high-end membership options. Golf as an industry has seen a resurgence post-pandemic, with more people picking up the sport and clubs seeing stronger engagement. If Aureus continues capitalizing on that momentum, whether through membership growth, events, or premium offerings, it could see stronger financial performance in the coming quarters. Another key factor? The real estate angle. Owning hundreds of acres of land in Florida isn't just about golf. It's an asset that could appreciate over time. If the company finds ways to monetize its properties beyond golf, such as through partnerships, sponsorships, or even future developments, it could unlock additional value for shareholders. Of course, the challenge for any golf business is seasonality and operational costs. Weather impacts play, and maintaining top-tier facilities isn't cheap. Aureus will need to show it can keep costs in check while continuing to attract golfers and members year-round. Investors should also watch for any expansion plans, whether the company looks to acquire more properties or enhance its existing clubs with new amenities. Right now, Aureus is sitting in an interesting spot. It's a niche business with a stable revenue model, but the real upside will come from how well it innovates beyond the traditional golf experience. If it can find ways to modernize, expand, or optimize operations, this could be a sleeper stock with long-term potential. Our review on ATER. Aterian Incorporated has had a bumpy ride in the e-commerce space, but the company just made a big statement of confidence with a $3 million stock buyback plan. That's the kind of move that usually gets investors' attention because it signals that management sees the stock as undervalued and is willing to invest in itself. For a company that has been working through a turnaround, this could be a sign that Aterian is stabilizing and looking ahead to growth. Now, let's talk about the numbers. Aterian's fourth quarter GAAP EPS loss of 18 cents was actually a big improvement over expectations, beating estimates by 34 cents. That's a significant beat, and while the company is still operating a loss, it shows they're making strides in improving their financials. Revenue came in at $24.61 million, also exceeding expectations by $1.13 million. These are the kinds of earnings beats that can boost investor confidence, especially in a company that's been working to refine its operations. Looking ahead, Aterian is projecting 2025 revenue between $104 million and $106 million, which gives investors a clearer roadmap of where the company sees itself in the near future. The e-commerce market remains highly competitive, and Aterian, which owns brands like Squatty Potty, H-Ohm Labs, and Mueller, relies heavily on Amazon for distribution. That's both an advantage and a risk. Amazon offers massive reach, but also means Aterian has to navigate platform policies, fees, and competition from other sellers. The buyback plan is a particularly interesting move because it suggests the company sees long-term value in its stock. When a company buys back shares, it reduces the total number of shares available, which can improve earnings per share over time and potentially increase stock price. It's a strong vote of confidence from management, and it indicates they believe the company is in a solid enough position to use cash for shareholder value rather than just survival mode. That said, Aterian still has challenges ahead. Margins in e-commerce are notoriously thin, and the company has been in cost-cutting mode for a while now. While it's encouraging to see earnings and revenue coming in ahead of expectations, Aterian still has to prove that it can consistently generate profitability. Investors should keep a close eye on future earnings reports, particularly how the company manages costs, expands beyond Amazon, and continues leveraging its data-driven approach to e-commerce. For now, Aterian looks like it's on the right path, and with the stock buyback adding some confidence to the mix, this could be a turnaround story in the making. But as with any small-cap e-commerce play, execution is everything. If they can keep improving margins and hit their 2025 revenue targets, there could be more upside. Our review on FBRX. Forte Biosciences Incorporated is a small-cap biotech with big ambitions, focusing on autoimmune diseases with its lead drug candidate, FB102. This CD122 antagonist is being developed for conditions like graft-versus-host disease, GVHD, vitiligo, and alopecia areata, targeting immune pathways that could have broader applications in autoimmune treatment. For investors, the key things to watch are clinical trial updates, funding strategies, and potential partnerships. Biotech development is expensive, so securing non-dilutive funding or a strategic partner could be a game changer, reducing risk while accelerating progress. The company also holds a U.S. patent for skin condition treatments, which could provide future expansion opportunities. At this stage, Forte is a high-risk, high-reward play. Success with FB102 could send the stock soaring, but like any clinical-stage biotech, setbacks or delays are always a risk. Investors with a long-term outlook and a tolerance for volatility may find this one worth watching. Our review on CSCI. COSCIENS Biopharma Inc, formerly Aterian, is making moves in both pharmaceuticals and cosmeceuticals with a focus on unmet medical needs. Best known for Masamorelin, Macrolin, Grivelin, an oral test for diagnosing adult growth hormone deficiency, AGHD. The company is also exploring the therapeutic potential of plant-based compounds, particularly avananthramides, which are found in skincare brands like Aveeno and Burt's Bees. Now, the latest development. COSCIENS has kicked off a Phase 2A clinical study for its avananthramides product, which is being tested for managing inflammatory conditions. The study will enroll 20 patients and evaluate two different dose levels, 480 milligrams and 960 milligrams per day. While still early stage, this could be a big step forward if the results show meaningful efficacy, as inflammation plays a role in countless chronic conditions. For investors, this signals a deeper push into the pharmaceutical potential of natural compounds, which could be a unique angle in the crowded biotech space. If this study delivers promising results, it could open doors for partnerships, regulatory advancements, and broader commercialization opportunities. Of course, it's still early, and biotech stocks are always a long game, but this is definitely a development worth keeping on the radar. Our review on SISI. Shineco Incorporated is a diversified holding company that operates in three main areas: rapid diagnostics, agriculture, and healthy meals. They're involved in developing and distributing diagnostic products for common diseases, producing agricultural goods like silk and fresh fruit, and offering healthy meals designed for people with metabolic health issues or those recovering from metabolic disorders. The company's latest push is expanding its healthy meals segment, which positions them well in the health and wellness space, a market that's been growing rapidly as consumers become more health conscious. With the increasing demand for plant-based and specialized dietary products, this could be a promising area for Shineco. For investors, Shineco's diversified approach offers some protection against risk by tapping into multiple growing industries. However, success will come down to how well the company executes across these segments. Tracking their quarterly progress will be key to understanding how well each business line is performing. If Shineco can scale its health products and maintains strong operations in diagnostics and agriculture. There's solid long-term growth potential for the stock. Please subscribe, give the video a like, and watch more from our playlist. Thanks.